an infinite amount of cash at the Federal Reserve. There is an infinite amount of cash at the Federal Reserve. There is an infinite amount of cash at the Federal Reserve.
Good morning, Bitcoin. Today is Tuesday, March 16th, 2021. My name is Thomas Hunt, and here's what's happening today in Bitcoin. Fake Elon Musk giveaway scam cost man £400,000. Trump's last-minute Bitcoin rule hits the wrong mark. What a crypto executive wishes investors knew before buying Bitcoin for the first time. But first, the price of Bitcoin is down 1.86% in the last 24 hours, with a last of 55,716, a high of 57,020, and a low of 53,346. That's $1 for 1,796 Satoshis. Volume was at 10,860 Bitcoins changing hands. The market continues to lean long, with 95% heading that direction. Bitcoin dominance was at 80%. 18 Satoshis for a penny. Fake Elon Musk giveaway scam cost man £400,000. Sebastian will always remember the night he lost £407,000 with equal parts anger and shame. The night leading up to it had been otherwise forgettable. He and his wife watched a series on Netflix, and before she went to bed, she left him on the sofa, messing about on his phone. Then he received a Twitter notification with news from Elon Musk. Sebastian told the BBC, Musk tweeted, "Dojo for Doge," and I wondered what it meant. There was a link to a new event below, so I clicked on it and saw that he was giving away Bitcoin. Sebastian followed the link to a professional-looking website where the Bitcoin giveaway looked to be in full swing. There was a timer counting down, and the website promised participants that they could double their money. The competition was apparently being run by Elon Musk's Tesla team. It invited people to send anything from 0.1 Bitcoin, worth approximately £4,300, to 20 Bitcoin, approximately £860,000, and the team would send back double the amount. Sebastian double-checked the verification logo next to Elon Musk's name, and then decided whether to send 5 or 10 Bitcoin. Take the maximum, I thought. This is definitely real. So I sent 10 Bitcoin. For the next 20 minutes as the timer wound down, Sebastian waited for the prize to land in his Bitcoin wallet. From his house in Cologne in Germany, he sat there refreshing the screen every 30 seconds. He saw Mr. Musk send a fresh cryptic tweet and felt reassured that the giveaway was real. But slowly the timer on the website ran down to 0, and Sebastian said, I realized then that it was a big fake. I threw my head on the sofa cushions and my heart was beating so hard. I thought I'd just thrown away the game changer for my family, my early retirement fund and all the upcoming holidays with my kids. I went upstairs and sat on the edge of the bed to tell my wife. I woke her up and told her I'd made a big mistake, a really big mistake. Sebastian, who asked that the BBC didn't use his real name, didn't sleep that last night. Instead, he spent hours emailing the scammer website and tweeting the fake Elon Musk Twitter account to try to get some or all of his money back. However, he eventually began to accept that the money was gone forever. Trump's last-minute Bitcoin rule hits the wrong mark. Cryptocurrencies held in regulated accounts will have significantly reduced functionality, but the utility of those who held directly will be unimpaired. In the waning days of the Trump administration, the Financial Crimes Enforcement Network proposed a rule aimed at closing anti-money laundering regulatory gaps for convertible virtual currency held in unhosted wallets. That is, cryptocurrencies such as Bitcoin held outside a regulated financial institution. The proposal drew strong negative reaction from regulated financial institutions that deal in cryptocurrencies, such as the big crypto exchanges and brokerage firms, and those involved in decentralized finance, or DeFi, a hot sector for crypto innovation. The proposal strikes at those who have a significant investment in crypto and use it for applications such as smart contracts and decentralized lending rather than routine payment functions. This means that crypto held in regulated accounts will have significantly reduced functionality, but the utility of crypto held directly will be unimpaired. Also, the dollar value of crypto would likely fall because the link between investment and economic value will be weakened. In other words, the economic value of crypto will not be harmed, only the price it commands in dollars. Most people think of money laundering as something big and scary. It's actually two separate things, one big and one scary. The big one is tax evasion. Most ordinary people have paid or received a wage that was not reported as required for payroll and income taxes, or paid cash to avoid sales tax or duties. Some rich people do large-scale versions of this using fraudulent bank accounts and offshore shell corporations. The money laundering part comes in when the cash re-enters the regulated financial system. For example, when a bar owner pockets some cash instead of entering it into the register, there's no laundering. The owner can spend it for small purchases without any effort at disguise. But if the owner wants to buy something big, like a house or a car, the cash needs to be put into a bank account. Bad people, such as terrorists, contract killers, or ransomware crooks, have the opposite problem. They want to disguise the destination of funds, leaving the regulated system rather than the source of funds entering, so they can't be found and their backers can't be indicted. This isn't big, as terrorism is not a major economic sector, but it is scary. FinCEN's proposed rule aims at scary money laundering. It requires financial institutions to record physical addresses of recipients if cryptocurrencies valued at $3,000 or more are moved out of regulated accounts into unhosted wallets. Funds that are in unhosted wallets can be exchanged for strong privacy cryptocurrency, like Monero or Dash, and delivered to anyone, anywhere, without much trace. The proposed rule won't prevent that, but it would give investigators a name and address of someone to question at the start of the trail. This kind of regulation invades the privacy of millions and creates paperwork headaches in hopes of giving a small amount of help in a handful of investigations. I suspect the most serious criminals, including the terrorists and their backers, keep the entire transaction outside the regulated financial system anyway, either by using only cash or physical items of value, or transacting in non-compliant jurisdictions. Still, the rules are similar to the rules for cash transactions. So if you think FinCEN should be told if you withdraw $10,000 in cash, then it makes sense it should be told if you send $10,000 to an unregulated wallet. So why does it say $3,000? The bigger issue is that the rule inhibits integrating crypto with a traditional financial system. That might be a good idea. A vibrant, innovative, and free crypto economy coexisting with a separate but equal regulated economy might be good. If everyone investing in crypto wanted to buy the things crypto makes possible, speculation would be cool and fundamentals would drive values. Exchanges of crypto for government currencies are not necessarily a good thing. Crypto skeptics share this view for the opposite reason. But if you're moving regulated assets in and out of crypto, whether as an exchange or a step in a financial intermediation, the proposed rule is a threat. If you hold crypto in the hope that its price in dollars will go up as opposed to the hopes of spending it in the future crypto economy, the rule could hurt you. It's harder to transfer money from the traditional financial system to crypto. The price of crypto in dollars probably goes down, although the value of crypto to crypto users goes up. The more regulators restrict the financial system they control, the more a free financial system has value. What a crypto executive wishes investors knew before buying Bitcoin for the first time. Adam Trademan, CEO and founder of BRD, I think that's Bread Wallet, a popular crypto wallet that boasts more than 7 million users, talks about the biggest mistakes he's seen newcomers making, as well as some tips to avoid them. Trademan says that anyone considering buying Bitcoin should get familiar with its movements so as not to get scared into selling their holdings if they see a drop soon after they buy. When Bitcoin broke 50,000, a bunch of new people bought in, and then you had savvy whales who took their winnings and caused a pullback. And then some spooked investors sold, and the whales bought back in at a lower price. New investors should strive to be unfazed when they see major movements, whether they're positive or negative. Be aware if you put X amount of money in, there will be a time when you open your wallet and you're down 30%, he says. There will also be a time when you're up 2x. When you have a situation where your money is up 2x or 3x, you'll think that it was all too easy. Stick to your guns and don't get greedy. If your goal was 2x growth and you hit that, sell it and be thankful that you hit this number. He adds that new investors often get caught up in the day-to-day fluctuations of the coins. A better strategy, Trademan argues, would be to buy, hold, and forget about it at least for a year. If you look at it every day, it can be nerve-wracking. We crypto-crazy people do that, but I don't think it's the right move for the average casual investor. To avoid this, Trademan advises new investors use the dollar cost averaging strategy, buying a little bit of Bitcoin every day at a wider range of prices to build their holdings over time. Don't just go all in and buy $5,000 worth of Bitcoin, he says, adding that it's more helpful psychologically not to have a single price at which you bought Bitcoin that your brain fixates on. He adds that there's no amount of Bitcoin a person can buy that makes it a good or bad investment, and that investors should only buy as much as they're comfortable losing if its value were to drop. He also suggests not getting sucked in to the world of altcoins. The Oakland A's are the first professional sport team to price tickets in Bitcoin. Go A's! Incredible news from the Oakland Athletics. They are selling a suite for 1 Bitcoin. Accordingly, the price of Bitcoin's gone down 15%. So the price of a suite for the Oakland Athletics has gone down 15%. They say they have more than 60 people who are interested, and that the Oakland Athletics are awesome and my favorite baseball team. So go A's. We did it again. All right. Now, if only they'd lower the price quite a lot, and then I could afford a suite. But not yet. Maybe. And again, you'd have to go there every day. You'd pretty much have to live in Oakland. So, not that good a deal. Thanks to everyone for donating to the new laptop fundraiser. This guy says $2. Donating with Lightning is fun. Buy another full node. And slapping Ben was fun. So much smoke. You can donate in the description down below or at Tallycoin. Check out the HAL Finny mug at shop.worldcryptonetwork.com. I've got mine. Do you have yours? Also, we have shirts. And the Treasures Don't Float 2.0. The price of Bitcoin is down 1.67% in the last 24 hours, with a last of 55,814, a high of 57,020, and a low of 53,346. That's $1 for 1,791 Satoshis. Volume was at 10,746 Bitcoins changing hands. The market continues to lean long, with 95% of the market heading that direction. Bitcoin dominance was at 80%. Thanks so much for watching. Be sure to give us a thumbs up down below and subscribe to the World Crypto Network. 73.2% of the people watching this have subscribed. Won't you join them? We do these shows every day. Why not subscribe to the World Crypto Network? It's free. Until next time, bye-bye.